Chasing breakouts and consolidating range-bound markets is one of the fastest ways to blow your account. If you're pattern trading, just stop. You need to trade in line with higher time frame context and make sure that you're looking at the right higher time frame context. So I'm going to show you exactly how to trade range-bound markets or just stay out completely. We're going to look at this 2.5 hour trade example on Euro New Zealand dollar. So I'm just going to take this away and first and foremost show you what consolidation looks like. So right here, we have essentially a retracing piece of consolidating price action. This is consolidating because what you're seeing is no follow through. You're basically getting new bullish momentum into the market, creating inbound internal range liquidity, and then no follow through. And then an exact same thing happens where we're getting new bearish internal range liquidity and no follow through. So you can just see, you just want to stay out of this unless you understand exactly what price is doing. So before we look at that, let's just touch on some theory. Range bound price action occurs when price consolidates between supply and demand with no clear directional bias. So you see what looks like a breakout just fails, and the exact same thing happens in reverse. Most traders just take every single in ranges like order blocks, fair value gaps, the creation of order flow, basically pattern trading without understanding higher time frame contacts, and it leads to crazy account bleed. You just take loss after loss after loss. So we want to avoid this to avoid low win rate and just bad psychology. So let's look at this example in more detail. So the first thing to do when looking at consolidation is start to understand what is price actually doing. And we can see here, I'm swing trading. So I'm looking at the 12-hour time frame. And I want to swing trade weekly, 2 weekly, and monthly positions. So the first thing I can do is look at overlaying the weekly time frame. And this gives us an indication as to what price is actually doing. And you can see we're in a weekly consolidation whereby price is sweeping below weekly candle ranges. So we've raided the external range liquidity at the base of this weekly candle range. And actually we get a CRT play out. So on the lower time frames, you can see sting into the low, shift, and then we push to the high. The external range liquidity at the high of this candle's range. But then what we're anticipating is for price to take off, and it doesn't, it just consolidates. Why is this? So we then get an opposing sweep. So we get a sweep of the external range liquidity at these highs, and so the next logical path for price is that we close inside this candle's range and target its low. But that doesn't happen either. What ends up happening is that we get more consolidation. So we get a new candle that sweeps this candle's range. We then get an inside bar, and then eventually we sweep the inside bar to go higher. So how can you just avoid all of this? When you're seeing weekly consolidation, you're seeing price action on your execution time frame just not following through, simply just go up another time frame. So yes, we could look at the monthly, and that will give us information, but we can just switch onto the 2 week time frame. And here we just get a very different story. So yes, we see the same price action, but essentially what happened is price is bearish and we sting down, we respect the internal range liquidity in this price leg, and then we sting below the internal range liquidity, stinging below the external range liquidity of the entire 2 week candle. And then we get a structure shift. So the swing point gets disrespected. So we have liquidation of the 2 week candle's low. Then we have, if we just zoom in here, the swing point right here being traded through because we had a bearish price leg with this bearish order block just traded straight through. So now you have two options. Either you get involved within this candle or you wait for the candle to close. So getting involved in this candle, you can simply take a position from these last sell to buy candles and cover the low. That eventually does play out. Or you can wait for the close of this candle. And then this consolidation starts to make sense. We're trading down, liquidating weekly and daily levels in here before trading towards our higher time frame target, which sits right here. because we've raided external range liquidity at the base of the candle, and now we want to target the high. So second option is once this candle closes, we wait for a reaction from price. So price trades down, we're in a bearish consolidating trend, and then we get a shift. Now, within the shift, we get the creation of a new 12-hour order block right here. So we have the last sell to buy candle. So you can buy from this position, but just know that instead of where you might have a traditional stop loss at the swing point, because you're trading consolidating range-bound price action, just be safer with your stop. So just trade or set your stop below the original low, the low of the manipulation candle. Then you just ensure that you avoid any sweeps in this area before price takes off. Then you can target the high, so you get a 1.74R trade, and eventually price takes off to this longer term high, and you've got over a 2.5R trade. It's actually a 3R trade and beyond. So how do we actually apply this? Essentially what you want to do is confirm liquidations of your higher time frame candles. So always trade from external range liquidity to the next point of opposing range liquidity. So your higher time frame has to make sense. If you're seeing consolidation on one of your intermediate time frames, just go up a time frame and see, does this trade still make sense? Wait for the creation of order flow or internal range liquidity in your favor to actually place trades, but be more conservative with your stop. So actually put your stop below the actual context that makes sense, which in the previous example was the 2-week manipulation candle. But ultimately, when it comes to consolidation and range-bound markets, do not force trades. Don't chase price action. Don't anticipate manipulation. Just wait for price to play out. Because even if we come back to the previous example, once we get this move, there's so much opportunity to get involved. So if you don't want to get involved here, just wait for price to show its hand and then take your next trade. That is how to trade consolidating markets and range-bound price action. My model is that I track and analyze 32 Forex pairs, including gold, silver, Bitcoin. I track 12-hour price action in conjunction with monthly, 2-weekly, and weekly candles. And I'm trading from external range liquidity points using lower time frame price action. Once you get good at this, you can do it in 10 to 15 minutes a day. So hit subscribe and I'll see you on the next video.